in reality. Kevin brings an incredible amount of skill, experience to the committee. And Kevin, did you want to say a little bit about your background? You don't need to. I don't mean to put you on the spot, but I'd love to hear.
Yeah, no problem. So Kevin Chambers, I grew up in McMinnville, graduate of McMinnville High School, went up to the Seattle area for college, and then worked as an institutional consultant in the financial world. So mostly working with big pension funds, pipe fitters and dock workers, that type of thing, mostly union pension funds. And then moved back to McMinnville to start taking over my father's business, his investment firm at Headwater Investment Consulting. And then, so I got my MBA at Willamette, and then now I'm one of the partners here at Headwater Investments, and we manage about 310 million in assets here at McMinnville. So happy to be part of the committee, and thank you all for having me.
Thank you for being part of the committee. We really appreciate it. So next on, and I would say, just for those of you who may not know Bill Sweat's background, since he's not here, is that he was, in fact, he spent 25 years in financial services, working with Fidelity Investments and Charles Schwab. He had all the SEC brokerage licenses, but he was primarily in a managerial position, not a trader. But he has certainly lots of financial experience and in that capacity. And then I would imagine with all the board experience he has a lot of experience in helping guide boards through financial decisions. So we're also really happy to have him join us. So the agenda today is, as I said, it's packed. The first thing up on the agenda is approval of the minutes, and it looks like we have only two people who, is Jim here? And I just don't see him. Jim?
His name is up there, so I think he's here in some capacity. Maybe he's on the Zoom call, but his camera's not on.
It's interesting. It would be good if he could respond. I just have this feeling he's not really on. Okay, so we need to approve the minutes, and Katie, if you would please make a motion to approve the minutes from the last quarter meeting, I would appreciate that.
Can you hear me? I'm trying. I actually have my computer going and my phone going because I couldn't get the sound going with my computer, so I had to improvise.
We can hear you.
Okay. Motion to approve the minutes from the last meeting. When was the last meeting? Sorry.
It was in
April.
April.
Oh.
Yeah, April. Yeah. So okay, that's good. Take that. So then we have only two people who were present at the last meeting, but I think there's some standard that we have that people who weren't present but are on the committee can still vote. Ken's nodding his head. So Kevin, if it's okay with you, I would ask you and Katie and me to vote to accept the minutes. So all those in favor of accepting the minutes, please say aye.
Aye.
Okay, done. So now we're going up to the market update, which is, oh, there's the minutes. So the market update.
Oh, here you go.
Here who goes. Okay, so we have the rate trends, and I did this for the year because this is also the end of the year report because we're on a fiscal year of June through July, and July through June, and so I have all the rates over the term that we're looking at for the year and noting most significantly, the tremendous increase in inflation during that period, which is certainly a big factor in the market today. And depending on who you listen to, what you read, it is either real inflation or it is a factor that's a result of comparing to the year ago when we were already in the depths of the pandemic. And I tend to vote with that position. So I think that even though if you're comparing expenses in June of 2021 to June of 2020, I think that it's probably a distortion to do that. So at any rate, it's a factor. And so one of the things, just because I thought it was interesting, was I put in this this little report that I believe I got this from, now I can't remember, but, oh, he's on the call. Good. So Jim is on the call, but can you talk, Jim? No. All right. Well, he's on the call, so that's good. Hopefully he'll be able to talk at some point. At any rate, so I thought it was interesting to just look at what made up inflation in the most recent month of June and the trend that's been going on. And if you don't already know, the biggest factor that's affecting the car market is a lack of chips. And the chips will be made eventually, but there's a very long turnaround period for chips. And they stopped producing during the pandemic, and they're gearing back up. So what's happened is there aren't very many new vehicles. So people are forced into the used car and truck market, and it's driving the price up. And that's significant, 45%. Another is fuel. So it's basically, it's pretty important to people. They need cars and they need to buy gas. So these are significant factors. But and airline fare, I mean, you don't have to fly, but these other things are pretty important to the people in our county. And so I would imagine that a lot of people here have been hit very hard by these increases. And so inflation is here, hopefully not to stay. So the fourth quarter report for the earnings trend, which is now complete for 2020, 2021, is down as we expected, but it's actually a little higher than what we had predicted. And it was 822. With the same portfolio, at this point, I would expect it to be closer to $650,000 for this fiscal year that we're in right now. Are there any questions about that? No? Okay. So the investment mix has changed to some degree. If you look back at each year, we're usually around this level. We're at 24 million in the bonds right now, and we've been at that level in the past, except for last year. And for some reason or another, maybe again because of the pandemic, at the end of 2020, we had just a little bit less in cash than we do now. And now we're closer matched to 2019 and 2018. And we have more investments in LGIP than we have in the past, simply because it's a very good rate of return right now. And we will have as much as we can in there and still make it so that finance can function. So that is the broad mix. The other is the breakdown within the investment portfolio of how we are invested today. And this is kind of it's a significant change from where we were at the beginning of the year, although I don't have that side by side. But I have been putting as much as I can into government bonds, particularly agencies. And I have not been buying municipal bonds because I'm a little leery and the rates have not been that great. Of corporate bonds, we had too many. So I am not buying corporate bonds at this point. And so the mix is gradually changing. LGIP is 57%, which is about right for us. The LGIF, we need to address the LGIF, which was the Local Government Investment Fund, or I don't know what that stood for. Anyway, it was more medium to long-term investments for people who wanted, in theory, to get a higher rate of return. And it was structured like a mutual fund. And we had $1 million, $1.2 million, I believe, in that. I'm not in favor of that type of investment for the county because it's not liquid. When we go to sell that security, we have to wait a month to get our cash, and we can only sell at the end of the month. So that is not anyone's definition. That is not liquid. And they have, I checked, not one institution in county government besides the metro area had any investments in this particular investment. And I think it's totally inappropriate for us. And I know the board voted on it, but I liquidated that because I wasn't in favor of it when we did it, and I haven't become more in favor of it as time goes on. Plus, the way the bond market is going right now, it's the longer term bonds that are getting hit by dropping rates. And when they're reinvesting and turning around, they've got a portfolio that is, 7 or 8 years out. And I'm just not comfortable with that length of maturity for our investments. So that's gone. We did have a gain of over a year and a half. We gained $2,451 on that investment. So at least we didn't lose money, but that's gone. And then we have here, for the first time, the Yamhill County ARPA funds are showing up. And that is money that was deposited, I don't know the exact date, but it was after our last meeting. The deposit was $10,401,459.50. And we put that in the LGIP. And so we are getting LGIP return on those funds. In order to do that, we have a limit, as we show up here, of 51 million for the total that we can have in LGIP. And so we had to pull down the amount that we had as a county in LGIP because the two are both considered our funds. And so now at this date, we had about 44 million and the limit is 51 million. So I had to buy some bonds in order to pull LGIP down in order to accommodate these new funds in our balance. I think that it's the responsible thing to do to make certain that our ARPA funds earn a good rate of return and yet are still liquid. And LGIP is the only way we can do that. So we're taking a little hit on our general fund return in order to accommodate the ARPA funds. Are there any questions about that?
How is the limit for LGIP set? Is it set by them to us, or is that set through our investment policy statement?
It's a statewide, it's set by them. And it goes up a little bit every year, but it's pretty much, that is the limit. And so municipalities who have a lot more funds than us are forced out into the bond market. And at this point, getting 60 basis points on LGIP is far preferable to going out and buying short-term bonds, which earn, as you know, a lot less.
And what What, in your opinion, what if any risks are there associated with the LGIP?
I think there's basically none. They have a reserve fund, and in addition to the fact that they have a diverse portfolio and incredibly well-trained, sophisticated investors for the state. I'm very, very happy with LG. What do you think, Mike? You've worked with them a long time.
Yeah, I agree exactly. Yeah, they've got a team of investors. They're highly educated, very attentive to the market. And it's true, there is no risk. We're not our value of the portfolio does not change as the market changes. What they just do is they adjust the interest rate based upon how the pool is doing. So we'll earn less or more based upon how the market is doing, but our principal, if you want to use that phrase, remains unchanged.
Right. Any other questions about that, Kevin?
Nope.
Okay. All right. Any other questions about anything else that I've covered at this point?
I guess I had one question,
Okay.
which was kind of related just with the investment mix of if there's any place for inflation protected bonds in the portfolio.
We can't do those.
We can't do those. Okay.
No.
Easy enough then.
Yeah. We're pretty limited as to what we can do. And for good reason, because people can get kind of creative with investing. And if we don't have strong guidelines and clear guidelines, it leaves it open for who knows what. Not that that's never happened, but we have a very good investment policy, which we will talk about soon. So moving on, the fourth quarter, the investment summary, we have an unrealized gain, or we did at the end of June, of 348,000. And monthly, our estimated 12-month income would be 347,000. Our yield on market is 1.45. Yield on cost is 1.47. Weighted average maturity is 2.52, which is great. And our average credit rating is within our guidelines, AA. And as you can see, the bond ratings over here on the right, you can see that because we have invested in a number of agencies and treasuries, it's brought our percentage very high in the AAA category. And but we still do have, and I want to point this out, we still have 3,877,000, or 16% of the portfolio that we would not be able to buy today if we were to look at our current standards for credit rating. And then we have this one grouping that is quite low and is on our watch list. But because we're heavily invested in agencies, our overall credit rating looks good. As I've said before, numbers can be misleading. And I think this might be a case where that is true. The benchmarks for the county, we're currently at 1.45, LGIP is 0.6, and then you can see as we go out, the longest that we would, under my guidance, go out would be 3 years, which is 0.46 at the time of this, but it's 0.37 basis points this morning. So it has gone down. This has been a crazy month when you're looking at interest rates and you're looking at what used to be a percentage point was significant. Now we talk basis points and it's like, oh my God, it went down 20 basis points. Well, it's not huge, but it does affect us. And so moving on to the fourth quarter.
Can I ask a quick question?
Oh,
Sorry.
yeah, I'm sorry. No, go ahead.
Sorry, I'm new. I'm probably going to ask questions.
Oh,
I'm
no,
sorry.
that's
My two questions are why, so if we're looking at those benchmarks, it seems like the yield of our portfolio is much higher.
Yes.
And the two questions are, is there a better benchmark to that would better reflect kind of our mix of assets? And then the second question is, where is the yield coming from that makes the current yield of the portfolio higher?
We have some, it's primarily from the corporate bonds that we have. And they were purchased over the last couple of years when rates were higher. The other thing that you just played into is that in reviewing this, I have to say that 60% of our corporate bonds actually fall below our rating guidelines. And of course, that means they're earning higher rates of return at the time of purchase. But I think the bulk of them were purchased below our guidelines when they were purchased. I looked back at a few of them and they were. And so we have not been following our own guidelines. And so we have higher yielding portfolio as a result of that. 22% of the portfolio, based on my hand calculation, was below grade for us. So as these bonds mature, our portfolio return will drop, because anything we're buying now is if we're lucky, we get 50 basis points, and some of them are 34, 35 basis points. So we're going to be joining the crowd pretty soon. So I would say that that's thanks to the former treasurer that we are as high as we are, but it's also not something I would do. And we have, in just your first meeting, I have a very different philosophy of investing for institutional funds than the previous treasurer. And consequently, I've had to make some significant changes. There's more activity in this portfolio over the last quarter than you will ever see again, because I was making some adjustments based on my own sense of interest rate risk with the longer term maturities. So we have 41% of the portfolio is now in agency bonds and 10% in treasury bonds. The state of Oregon, we have 3.6, which I would continue to do. And then we have the three corporations that this is not a high percentage, but just those are the top holdings that we have. And as I was discussing, we have maturity constraints. And at this point, with the adjustments that I made this last quarter, we are well within our maturity constraints. If I were to, I'm getting message. If you'll just bear with me a second, I am getting messages from both Katie and Jim, and I want to see what they're saying. So Katie is saying, oh, this is an old message. I don't see a new message. Okay, sorry about that. The portfolio maturity has come down considerably. I would target for future purchases 3 to 3.5 years, as I'm trying to create a bond ladder for maturities and cash flow purposes. I left, when we talk about the investment policy, I left it at 60 months because I don't want to limit not only my availability of buying longer term, but if someone else were treasurer, they might want to invest longer. And I'm not trying to tailor the investment policy for me. I'm tailoring it to what conforms with other county and state guidelines as to how we should be managing our portfolio. Are there any questions on that? Okay. And this is a different way than we've looked at the callable bonds before. Most agency bonds are callable. It's just the nature of the bond. So even though I might buy a 3-year bond Federal Home Loan Bank, it could be callable in 6 months. So that puts them over into the far right category. And what the Zions has done is they've calculated maturity date both on the maturity period, both on the maturity date and the call date. So based on the fact that we're so heavy in agencies, 50% of our portfolio could mature in the next 12 months. And in fact, it might. So,
Chris,
yes.
I'm sorry to interrupt. I was trying to, I know I wanted you to be able to finish your thought, but I noticed on the display screen that chat window is still up and is covering the documents. I don't know if I'm the only one seeing that.
No.
Or it's me. It's my technical issue. I apologize.
No, that's okay. The chat window, I didn't, okay. Well, fix it, Ken. We have enough problems around here. So anyway, so that's where we are. And I'm comfortable with that because I think if we can earn higher rates of return on these agencies and yet have the potential that they could get called away, I would rather have that than to earn a higher rate and know that the bonds, we have to hold them for 7 years. We had a bond in our portfolio with a 9-year maturity. And the reason behind that was that Treasurer Green was trying to match the funds that were being held for the solid waste. And my sense is that those solid waste funds are not as fixed at this point as they may have been. I think we're looking at a changing climate for how we manage solid waste funds and what we get. And that's something that the commissioners certainly are in the middle of right now from the fund. So anyway, so that's where we are in the callable bonds. Here's where we get to the really interesting thing. We had, because we had to accommodate the $10 million that came in from the ARPA funds, we did invest $10 million into the bond market. And I feel we were able to get some fairly good bonds given today's market that were still relatively short term and high quality. Most of them are Federal Home Loan Bank. And I had to do this over like a 3-day period in order to accommodate the limits that we had on the LGIP. So fortunately, the timing was good and we got some good bonds. During the same period, of course, we've had some bonds mature or have been called away. And they totaled $1,288,000. So that's another factor over the quarter. We do not have too many maturing or potentially callable bonds in the remainder of the calendar year. This is the bugaboo right here, the fourth quarter sales. I made the decision to sell anything that was longer than 4 years, no matter what the quality, no matter what, because I wanted to be able to balance it out so that we didn't have, if I only cherry picked and sold the things that were actually down, then we would have a huge realized loss. And so I went in and sold both the good with the bad with the limit of 4 years. And so we ended up with a realized loss of $5,800. And that includes the $2,100 that I told you last report that was the bond that should never have been purchased, that we sold in April. Some of these bonds have huge losses, some of them have huge gains. And so it was balanced out. This was a very tough thing to do. I will probably second guess it for at least another year in the market while I sit and watch. I will not be selling bonds. I do not expect to be selling any bonds unless there's a serious problem in the future. Are there questions about that? Well, okay. If you have questions that you don't want to voice in a public setting, feel free to contact me. As I said, it was very tough. I worked with a number of different brokers. And as you can see, this is an issue right here that I wanted to address. As you see the array of people that I dealt with when I was selling these bonds, I did not just go through one broker. And the same is true over here on the other side. When I was buying, I went through the 3 of our broker dealers, because particularly when I was buying these bonds, which were mostly all new issues, there is no difference between the price between Piper Sandler, Binding Sparks, and MBS. And I wanted the people who work hard for me to get something in return for that work. And so I spread it out, and they really appreciated that, because I could have just, as I said, just gone with one, and whoever it was that I talked to that day. And I'm not going to deal with my broker dealers in that fashion. The credit watch list is, these are the bonds that are in fact what I consider serious problems in their credit rating. Now, they're still investment grade, kind of, barely, depends on who you talk to. Oracle is a big part of that. I personally, they're not long-term. I don't think we're going to take a loss on Oracle. I would prefer not to sell it. Wells Fargo, the one that matured 7/26/21 did mature, so we only have 200,000 left, and that's only for another year. And so those are my recommendation. Does anybody else have anything to add or say about that?
I have a process question. How is the unrealized gain calculated? Gain or loss calculated?
It's calculated by Zions, who does handle our accounts. When I did it manually myself, I just looked at purchase price versus sales price, and
for the realized gains, right? But
for the realized gains. The unrealized gains is the same thing. Now, one of the things that I have a challenge with Zions is when they're looking at individual bonds, they calculate it based on the purchase price. But when they do the whole portfolio, they're basing it on, one of their numbers is based on the price that came on the books when they took the account over, which was just this last quarter. And so that number is very distorted. So they have one number that is valid based on purchase price. The other one is based on transfer date.
I guess my question more was concerning the projected sales price, because I know that just from talking to you, but also just watching bond markets, they're a little illiquid right now. It's not.
Yeah, they are.
It's not very easy to find buyers. So I was just wondering if they're using like a third party or something to calculate that, or if you don't know, that's fine too.
No, they're actually just basing it on the day that the report is generated, the value on that day. They're not projecting. That would be a lot more sophisticated than I think they're capable of, quite frankly. Plus, they are not there to, they're not really managing the portfolio, they're only holding the portfolio. If we were with a broker dealer, which we used to be, we might be able to get that kind of information. Like Piper Sandler has some great reports that they produce. I would love to be able to deal with them, but we can't.
Okay.
But we're limited. And because we're not selling normally, it's not a huge issue. So we haven't spent too. Now this non-compliance trade here, this is something that's very embarrassing and humbling to me. I made this trade. I bought Royal Bank of Canada in January. Now I bought it I bought it in February. And I have to admit that it does not conform to our credit policy. And it's a good bond. and just like many of ours that don't conform are, but I shouldn't have purchased it. And I can't, the only defense that I can give is that when I purchased it, I was really quite new, and Treasurer Green, and this is my fault, but Treasurer Green told me that we could buy bonds that were A or higher, even though our credit policy was different than that. And I just kind of tucked that in the back of my mind and said, oh, A, we could buy that. A2, that's great. And the other thing, of course, that he told me was that one of the reasons is that our ratings were low because our credit ratings were low is because we were able to buy these corporates for much lower rating than we would something else. I should have thought this through more. And I have tons of documentation on this trade. I mean, I have everything. There is no question that this bond was purchased at a lower rating than what I should have purchased. And it would be remiss if I didn't acknowledge that that was my trade and lumped it in with all the other trades. And so there you go. Are there any questions, comments about that? Okay, it's a good bond.
I guess what the credit rating restriction is that self-imposed through our investment policy, or is that set by some type of government restriction?
It is self-imposed by our policy, but it conforms to what most of the state and the county. I mean, if we wanted to change that limitation, we'd have to get approval from the state. So
Okay.
it's pretty much locked in. And with my experience, which was not institutional, and as a retail trader, this would be a very acceptable bond. And it was hard for me to switch over my mentality from retail to institutional so quickly. And I looked at that and I thought, oh, that's a great bond. And, I would buy that in my portfolio in a minute, in a heartbeat, but it's not appropriate. And so I recommend keeping it because there's nothing wrong with the bond, but just know that I will not be buying bonds with a rating of A2A because they are below the AA minus, which is the policy minimum.
So Chris, in a situation like that, and maybe Mike can weigh in on this, in a situation like that, or maybe just a comment from Mike Barnhart, having been a treasurer and just eyeballing this in terms of what the investment policy is, what the state requirements are, and in this situation, what is sort of the observation or the recommendation?
Is that a question for me directly?
Yeah, Mike, I was just because you've kind of had some time in the saddle on this type of stuff, what your thoughts on this would be for all of us.
And I'll defer to Chris on our investment policy because I haven't looked at that in a while. But I just think that the statute says corporate indebtedness can be rated by Moody's as A1 or AA negative. And I sometimes get a little confused on what is A1 versus AA, what is A2 versus AA. So it says here by Moody's A-1. So, but does our policy say something more restrictive, Chris?
It does. It's right down here. When you go here, if you look at this line right here, that's our policy right there. So it's AA3 for Moody's, and it was A2, which is down here. And then it was our policy's AA minus, and this is A, and AA minus, and this was A. So it's still, if you look at the descriptor, it's high credit quality with low credit risk. It's still a solid bond.
Yeah.
But it shouldn't have been purchased.
What the auditors will do when they see this is they'll make their own decision about whether it's a violation of our policy or a violation of the state regulation. Because there's also that rule that if the business enterprise has a headquarter in Oregon and they have some percents, 50% workforce or 50% assets in Oregon, then you can even go down to A2. You can go a little lower if they have Oregon presence. But again, I don't know RBC's background at all.
Yeah, we had, it's all matured, but we had several other RBC bonds in the portfolio, which is another thing that gave me an artificial comfort zone. We have the others in the portfolio. The auditors last year brought up one that was in the portfolio that Treasurer Green had purchased. And that one is still in the portfolio. If you read our investment policy, it says it's up to the treasurer whether or not to hold on to something that has been invested in a way, but it's also up to the treasurer to report that to the committee, and which I'm doing. As I said, it's not a, if you look at our current portfolio, it's consistent with what we have, but that doesn't make it right. Anybody else have any? Commissioner Starrett, does that answer your question?
Yes, thank you. I appreciate that. And thank you, Mike.
Yeah. So I want to be really clear that when, and hopefully I don't do this again, but when I make an error in the future, it would always be made note of, and that if I had not done this, you would never know. And I just want you to know that that's the integrity that I am bringing to the position, that I own what I do, that I will always try and do what is in the policy, which we will look at today. And hopefully I will never make this kind of error. I was maybe 5 weeks into the job at the time that I did this. It's not an excuse, it's an explanation. So I apologize. Okay, moving on. Welcome, Jim. I see.
Hi there.
Hi.
Been struggling today with the program, but finally in.
Okay, well, we're glad to have you. And what would be your input on this? Because, and I'm assuming you've heard and have seen the item Royal Bank of Canada that we're discussing. Do you have anything to add to that discussion?
Actually, what's the issue with the Royal Bank of Canada?
I'm sorry. It was purchased. It's not. It doesn't comply with our credit rating policy, and I bought it in February, and so therefore, I made an error when I purchased it, and I'm recommending that we hold it to maturity because it's a good bond.
And Chris, this is Mike again. Sorry, I'm reading this a little closer, and I agree with your assessment now. You are correct. It is not in compliance with the statute here.
Okay.
So just, yeah, I was wrong when I said I thought it was okay.
Yeah, no, it's not.
Okay.
Yeah, I'd be fine holding it then.
Yeah. Okay. All right. And I guess we've lost Katie. We gain one, we lose one. All right. So this is, as an explanation, and this has now been added. This is, I think, a very good visual that shows credit ratings and what our line is here is there. So anything that I buy needs to be at least this high. And this one that I did buy was this. We have some that are down here, which I want to emphasize is still considered good credit quality, even though they are at low levels with moderate credit risk. obviously we don't want to buy these bonds and we want to stay up here. But we have these. So it's a guideline that for me, if anything falls down into this yellow, at least it's yellow on my screen, category that we need, that's when I put it on a watch list and for us. And obviously we don't ever want to see that lower portion in our portfolio. We need to sell something very quickly if it fell into that category. Any questions on that? I really like this one. So one thing that we are required to do based on the investment policy is we're supposed to have in writing internal controls for investments that puts the responsibility of monitoring what I do and what anybody else does in connection with the investment. And it's Mike Barnhart helped me work on this because this is something that we share a responsibility for. And I think that the two of us did a great job. Mike brings a whole different perspective and responsibilities to this than I do. So Mike, did you want to say anything about this?
Yeah, I'll just say this, the auditors just want a brief overview of how the investments work, the procedural process. And Chris, we might want to take this out of the one you're going to put here, is where it says, for example, the little blue work paper 9700-01. Those are auditor references. We could probably remove them.
Okay.
So this is just used for the auditors just to get a feeling of the process and procedure. It's not a detailed.
Oh, okay. So I could just change that to our investment policy.
Exactly. Yeah.
County investment policy.
I don't know what 9700-01 is, but they do.
Okay. All right.
But
I don't either.
It's a brief overview. It's not audited. It's just to give them an indicator of what our controls are in general.
Yeah. Yeah. And we are required under our own policy to have this in writing. And so I added things that our investment policy said needed to be watched and make certain that we're doing. And that's the bulleted internal controls on this page are straight from our investment policy. And I can be quite comfortable that all of this is being done through finance and through the procedures that we have set up and the separation that we have between what my transactions and the actual completion of those transactions by the finance department really keeps a good separation. And now we have custodial safekeeping, which we didn't before. We never take physical delivery of securities. And it's very clear, and it says up above who does what, and staff training. We're going to have the auditors come, compliance with the investment policy. So all of that, to some degree, is handled by the finance department, but it's also handled by those of you who sit on the investment committee. Because if you see something that, because you have studied the investment policy and memorized it, that I have done something that you think is not in conform to this, then it would be something that I would hope you would bring up either directly to me or in one of these meetings so that we can make certain that we can say, yeah, we're doing what we should do. And when mistakes are made, like the one I made, they're caught. And so that's that. Any questions on that? Thanks, Mike, for your help on that. And I'm not certain, but it's my feeling that this probably should be voted on by the county commissioners as well. So I will, and I just think because it is semi-legal, that it should be adopted by the county commissioners. And so I will include it when I send in the new, or the updated, it's not really new, investment policy as well, so that we're all on the same page. And isn't this beautiful? Look at this. Look at that pretty picture. Some of you are sitting there right now.
Chris,
Yes,
if I may, if that is something that as far as the internal controls policy, if it's not, if it's something that you're wanting the board to consider and take action on, it might be good for this committee to make a motion to approve that or approve,
you're absolutely right.
to do that recommendation as an action, and then you could bring that to the Board of Commissioners.
Yes, okay, I agree. Thank you. So do I have a motion to approve this with the correction as requested by Mike Barnhart for the references to the 9700.01?
I'd move to approve the internal controls procedures and forwarded them to the commissioners for approval.
Thank you. We have a second?
I'll second that.
Thank you. And all those in favor?
Aye.
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 Aye. Okay. So, and I don't know, is Katie still on here? Katie, are you on?
Yes, can you hear me?
I can, yeah. So you voted aye.
Aye,
Okay, thank you.
yes.
Okay. So thank you for that. And thanks again to Mike for working with me on that. He needed it for something different, and it was the answer to my concern about the policy stating that we have a control policy in effect, which we did not have a formal one before now. So the Yamhill County Investment Policy, I've made very few changes. I read it over. It's very much boilerplate for the state. The state has a sample of what we should have in our policy, and it is accurate. I did take the time to go through all the investment policies of other counties that were willing to share them with me. And I would say this is probably one of the best. So this was done between Treasurer Green and Christian. And I think they did a good job on it. So there's just a couple of things that I highlighted, the changes that I'm recommending. The range was really low. It was like between 12 million and 20 million. And obviously we're already higher than that. So the amount of funds that are going to be in this range are more likely to be between 12 million as a low, I hope we never get there, to about 90 million at the high, but we might hit in November and sometimes higher than that, but 90 million should cover us. So I did make that change. Then when we go down to, so under competitive transactions on page 7, I added the investment officer will select the quote which satisfies the investment objectives of the investment portfolio within the parameters of this policy. That was something that was in a couple of other policies. And what that allows is that if, and this has actually occurred where I have 3 bids and one is lower than the other 2, I can still select a different bid if there's something about it that meets the investment portfolio parameters. That would be more likely to happen when I just sent out a generic, I want to double a corporate bond with the 2-year maturity and, send me whatever you have that you think is the best. And then it would be up to me to judge what is the best. Maybe one bond is AA plus, but it's a lower return, or maybe one bond is 36 months instead of 30. So it gives me the discretion to decide amongst those which ones I take that may not necessarily be the highest rate of return, or may not necessarily be the shortest, so you get the drift. So I would like to add that in. Are there any questions or concerns about that? Now, what happened to Kevin? Kevin?
I'm here.
Oh, you're here. Okay. All right. Good. So there's that. And then The next thing that I added, which is in most other, is nothing in this policy will prevent Treasury staff from immediately purchasing an investment that suddenly becomes available and meets an existing need. It is recognized that investments can both become available and sell out in a matter of minutes. The investment officer shall use professional judgment before buying an investment without competitive quotes. This, I think, is essential because sometimes, something is thrown out there and it's really good and it needs to be taken immediately. I have found so far that my broker dealers are so responsive that I usually can get other bids very quickly. But if for some reason I couldn't, this gives me the leeway to buy. Now, this is totally dependent on the treasurer of being knowledgeable about current rates and what's going on in the market. And I try to do that. Once again, it is a reflection of a confidence that is placed in the treasurer to actually know what they're doing. So are there any questions about that? Comments? Okay. Let me see, what else do we have? It's pretty straightforward here. Oh, this whole chart is new, nothing's changed, but it's understandable. And, if you look back on what we had before, you can see where maybe it was a little confusing because it was actually backwards. And the old chart where it said minimum rate Moody's, underneath it was the ratings for, or it didn't break it out. It said minimum rate, Standard & Poor's, Moody's, but then it was all run together. And then the actual rates were backwards. And so it didn't jive with what you might look at. In other words, it would say minimum rating, and it would say AA minus under next to Moody's, and Moody's doesn't have AA minus. So it was incorrect. So it confused me. So I decided after looking at other people's policies that they had some clear charts. And so nothing's changed. It's just the format. Any questions about that?
Chris, I have a question.
Yeah.
I think in the old policy, or the one that we're replacing, it had below municipal debt, and then it had state of Oregon, and then it had states of Idaho, California, and Washington with a 25% limit. And it looks like we've eliminated that. And I'm not sure if that's meaningful or not, but I just wanted to ask the question.
I see. Municipal debt total would be 35%. And so in a way that is a difference because that's gone. I can add that back. I don't have any problem doing that.
Well, it doesn't bother me either way. I just want to
Yeah.
ask, because I think your overall limit's 35%, and then of that, 25% can be in Oregon.
Yeah, that's kind of what I was thinking when I changed that, because we're only allowed to buy in those states, those other states. We're not allowed to buy outside of those states. So yeah, all of municipal debt would be including those states. And so, yeah, it seems to me it makes sense, but maybe I need to list those states in there because that would be helpful. I'll actually change that, Jim. Put at least a reference to the fact that those states are the only states that we're allowed to buy municipal bonds from, because that's currently not in here and it could be confusing.
Okay, I think that'd be a good idea to list the states that are eligible then.
Yeah, no, thank you. I will do that. And then these minimum average credit ratings, once again, I'm looking here. Oh, this is the average. I just spelled that out differently. It's the same. One thing I wanted to ask those of you who are investment professionals is one of the things that the state does in managing the the LGIP is they have a number system, and they assign numbers to each rating level, and then they average the numbers to come up with the average credit rating. And and they go with the lowest. So in other words, if a bond was A+ by Fitch and AA3 by Moody's, they would take the A+ rating as being the rating, and then they would determine the number based on the lower of the two. Does that make sense to you, or is that overkill?
It feels like a little overkill just because we're only buying such high quality bonds. But
Okay.
That would be my opinion.
Yeah, it's a lot more work for me, so that's fine. One of the challenges that I have is that Zions, for some reason or another, insists on listing all of our agencies as non-rated, so the calculation doesn't include them, so I can't use their calculation. So I do have to do the calculation myself, which is fairly simple to do. It's really only the corporates that are in question. Jim, what do you think?
I'd agree with Kevin. I wouldn't convert it to a numeric system. I would just keep with the letter scoring from the agencies. And I don't know, are you required to score the agency, the U.S. agency debt? We just exclude that. We don't consider the direct guarantees and the implied guarantees of the U.S. government. We just exclude from rating.
Well, of course, if we did that, our ratings would look terrible, but yeah, they would, because we have all these low quality bonds. Yeah, so that might be something we could talk more about whether we want to change that. Hopefully, as the portfolio goes up in quality, that would make more sense. Not that we're trying to hide anything, but there will be a point, hopefully, where we only have 2 million in corporates, and so our whole rating would be based on $2 million as opposed to the portfolio of 25. So that seems a little distorted. Yeah, so I'll think more about that. There's nothing in the policy that says what I have to do, but I like it. It bothers me that our Zion's report is not accurate, and because they distort it. They say we have 50% unrated bonds, and they calculate the average, including these. They say they're lower. They rate them like BBB or something. It's a quirk in their reporting. So I added this chart, as we've already been through, and then this highlighted red, budgeted operating expenditures, blah blah blah. Mike has suggested that we remove that from the policy because it's state law and he already does it, and it's really not necessarily part of an investment policy. So if no one objects to that, I will do that next time that we present this. That should be deleted. Any questions about that? Okay. And this is the same content in a different order for reporting, because once again, I found it confusing to know what was supposed to be included in reports. And so there's no changes. This I highlighted because here's what I just did. And it was in there. That's not new, but violations of portfolio guidelines are non-compliance issues that occurred during the prior period that are outstanding should be reported. And that's what I just did. And then there's the more data on the current portfolio at the end. And so I think it's up to you guys, but I think that what I would like to do with this would be to go through and make those little changes and then resubmit it next quarter, because we don't need to rush on this. And then we can vote on it then, and then I can send it to the commissioners then, knowing that everybody's seen the final version. Does that make sense? Yeah, okay.
That sounds fine.
Yeah, especially because I'm adding that section, Jim, that you suggested about the municipals. It seems important. So that being said, at this point is a time for any general questions, discussions, anything else that you would like to talk about today. Nothing. Well, okay. So thank you for your time. Thank you for being here. We did start later, so we ran about the usual hour. I'm sorry for the complications. I don't really know what happened, but I'm sure it was my fault. And so as long as I'm taking blame for things today, I'll add that to it. And then we can be done with it, because I promise you, I will never make that error again. Well, maybe the link error again, but nothing else. And I do want to reiterate, because, and this has nothing to do with me, but we did purchase 60% of our corporate bonds below quality when they were purchased. And so this is not a new thing for our portfolio. Some of them may have been downgraded, but most of them, I looked back and they were purchased below our ratings. And I think part of that is the fact that I think that it's very hard with the rating system to understand the fact that AA3 is higher than A1. I mean, I think that, obviously it should be understood, and that's not about me. This is about Treasurer Green and his purchases. I do not believe that he intentionally bought bonds that were under our credit rating. I do not believe that. So I always feel like when I say things that are happening, that it sounds like I'm blaming Treasurer Green, and far from it. I think he did a good job, and maybe he, colored outside of the lines. But like I like to say, there can be really thick gray lines sometimes, and that's where he was. So, anything else for the good of the cause? Well, then do I need to ask people to adjourn the meeting, Ken? Oh, okay. So this meeting is adjourned. I will see you all in a quarter, and enjoy your summer. Stay cool, stay healthy, and stay relaxed. Bye.
Thank you. Thanks, everybody.
Thank you.
Thank you.